So here we are, Sean. 3 months ago, we last had a discussion about what we thought was going to happen in the markets, and Trump was just coming into power. The 3 months has already flown by, and a lot of what we talked about has come to pass. Volatility, risk being in the system. So maybe bring us up to date as to where we are now in the cycle and what we're looking at maybe over the next quarter and for the rest of the year.
Yeah, so we anticipated a lot of volatility coming into this year. Trump had made his plans, pretty loudly. He'd spoken about what he was aiming to do. I think the difficulty was that some of the actual measures that he implemented and the back and forth on a lot of those arrangements caused additional volatility. So we saw a retreat in the US equity market, and we saw a rotation into European markets, a bit more defensive. On the Russia-Ukraine side as well, we saw Europe administering, defense fiscal spending. That's also positive for their economy. So it was a flight to safety in the sense that there was just too much uncertainty around what Trump was actually going to do. There was a lot of talk and there was a lot of back and forth, but ultimately it's what actually occurs that's important. Moving forward, there are a couple of days that stand out. So 2nd of April is what he's claimed to be this Liberation Day. That's when we'll get some further detail on what the actual figures will be for a number of those tariffs. Or ultimately he could push them back again, and that will provide a bit of relief again for companies. He's in a position where he's kind of creating pain to then give himself the ability to ease that pain, I think, at the moment.
Okay, that makes sense. So from a client point of view, it's going to be more volatility, more uncertainty, which can be very unsettling. What's the messaging, I guess, to clients and over the short term and also the longer term?
Yeah, so first of all, with volatility, it's not possible to consistently time the market at the bottoms and the tops, things like that. Through a bout of volatility like this, you can find that from the fall to then recovery, it happens relatively fast. So we wouldn't suggest timing it. We suggest looking beyond the current short-term volatility and remaining focused on long-term asset allocation. We still believe there's strength in the US economy, even though growth has been revised down slightly because of maybe higher inflation and because of these tariffs reduce consumer and business confidence. But the US is still a powerhouse. It could be possible that the Europe rally has overshot, because it was a quick reaction to Trump's policies almost. Whereas a lot of the economic data, it's okay, but it's not as strong as the US still. So I would say for clients, it's important to remember the long-term goals and not to fall to short-term bouts of volatility or uncertainty, because they can quickly turn around as quickly as they appear to be quite negative.
Yeah, so for clients, it's kind of buckle your seatbelts and just hang in there and just focus on that longer term view.
Yeah.
Thank you very much.